Abhishek, Makkar, Maxima Divestitures.
Yes.
Thanks for coming, man.
Thanks for having me here.
This is your first podcast. This is my third podcast, so I'm pretty much an expert.
A seasoned professional.
Yeah. We are here to talk about M&A, so buying and selling of businesses. Why don't you tell us where Maxima fits into that?
Yeah, I'll start off by, what is a merger and what is an acquisition? It's simply just a business transaction where you have an ownership or business units that are getting transferred or merged into another company. So mergers, you really have two or more companies or business units that are as standalone. You know exactly who and what they are, what they do, and you develop a plan of how they're going to look when they come together. Acquisitions can be done by an individual, a group like a private equity, a strategic like a competitor where one is acquiring another. So divestiture, sale on one side, and a acquisition or merger on the other. So where Maxima fits in is, if you take a look at statistic, there's only 1 out of 10 companies that actually sell, and the main issue is the value. Value is a big issue of why the others don't and why some do. So having an advisor is important because you can really come in and increase those odds, find ways to increase those odds. Maxima has been doing this for 30 years. David Braun, the founding partner, we work on, like you said, buy sides. So that's where you have a company looking to make a strategic acquisition to grow. We work on sell sides. That's simply a company or a business group looking to sell or exit. We work on opportunity valuations, so that's when you have a group that wants to make an acquisition and they're trying to validate a purchase price, or a company just wanting to know what their value is. We've also started getting into a little bit of capital raise opportunities, so a new buyer or group that's looking to make an acquisition, or a company that's got a specific project that they need funds for, where the banks can't or won't participate. So that's where Maxima comes in. It's anything related to a transaction advisory service.
So buy side versus sell side. Did you say that 80% of your business tends to be sell side?
Yeah. 80% is sell side. It really depends on where we are in the market.
Right.
So when we were in 2020, interest rates were low, cost of capital was very low. That's when there's a lot of buyers that come wanting to make their first acquisition, but typically it's a sell side business.
I know a couple of people. I'm thinking of one in particular who they think they can sell their business on their own. And, it might be through a Kijiji ad or whatever. I'm not saying it can't be done, but every time I've seen it attempted, it looks pretty painful. And, maybe can you just hammer home the point on what an M&A advisor really brings to the transaction? Because intermediary, it really kind of undersells the point.
Mm-hmm. Yeah, that's great. Selling a business is one of the toughest decisions that a business owner makes. They've built this business. It's their baby. It's provided a good, if not great, life for them. So it's an emotional roller coaster. So having the bench strength to support you during this time, like you said, it's really underestimated in the industry. Like you said, business owners, they think they can do it themselves. A transaction by itself is a full-time job. And most of these owners already have a full-time job. So you have a lot of plates spinning all the time. You're adding a few more plates, and there will eventually be a point where something slips the crack. And the last thing that you want is your employees finding out. And that's what I call a slippage. They get spooked. they start wondering, well, do I have a job tomorrow? Or how is this new owner going to treat me and us? So having an advisor early in the process really increases that bench strength, and I'll use that a lot today. Bench strength. It helps the quality of the transaction, and it really helps the success rate of the transaction. We're looking at it in a way that a buyer is going to be focused in on it. We're looking at the strengths, the opportunities. We're going to focus in on where the key areas of improvements are. And if we're involved in the process early enough, we do have the chance to turn these potential areas of opportunities or weaknesses into strengths. Business owners, you could do it by yourself, absolutely. But having that bench strength really helps with value as well.
Yeah, I know. I mean, I've seen my share of deals, and people get so stinking skittish. Both sides get so skittish in a business sale. And again, like to your point, like somebody has their entire life and identity tied up in this business, and then somebody else, the buyer, usually has a ton of money on the line. And the M&A advisor sometimes is just serving as a therapist for both sides, just to keep everybody at the table, just to be like, okay, just chill. Like, we're going to get through this together.
Right. Yeah.
But I know I'm working with a company in Ontario, and it's kind of like a search fund, but the gist is they exclusively look at off-market deals, right? And part of the motivation for that is, I think there's a feeling that off-market means you're not going to compete for the deal, so maybe you get a better price, and that there might be some truth to that, right? The rub is that it is a nightmare to complete due diligence. Nothing's ready. It's tough to find the paperwork that you want, right? Whereas, an advisor, there's a sim, like they're helping package it for everybody that frankly needs to be involved. It could be the lender, it could be the buyer,
right?
Accountants, lawyers, transaction advisory, right? Like it's an underappreciated role.
Yeah.
It's not like a real estate agent, right?
No
disrespect.
No disrespect. No, you're absolutely right. Like you said, M&A advisors, we really look at what the value of the company is. As is there a compelling story, and how do we properly communicate that compelling story to the right buyers? The right buyer is going to value what the owner values. And it's our job as advisors to make sure that we're able to take that compelling story and communicate it. There's, like you said, there's multiple types of buyers, whether it's private equity groups, strategic groups. You really need to know how to handle each. They don't talk like each other. They don't look at models like each other, and they definitely don't value the company the same as the other would. So when we do our range of value process, we look at it in a way of, is this company really a transaction for a private equity fund, or is it a bolt-on addition for a strategic? And like I said, there's two variations of each. An advisor will be able to increase the value beyond the valuation that was set. Typically, a good advisor will pay for themselves in just the increased value that they're able to bring in on an offer versus an owner trying to do it themselves.
All right. Okay, let's talk about preparing for a transaction. You can take this any way you want, right? Like there's going to be a different response for the buyer than, let's say, a seller.
Yeah.
But I imagine that for either side, when they start thinking about doing a deal, they're going to talk to several M&A advisors. What should they be considering? I'm assuming they're going to compare, right? And they might think about price, but there's a lot more to this exercise. So what advice would you give to somebody that's kind of shopping advisors?
Well, like you said, when you're preparing for a transaction, it's most businesses and business owners, you can't wake up one morning and decide you're going to go to market. It takes a lot of time to properly clean up, optimize the company, the management, particularly the financials. So our experience is the earlier that an advisor can come into the process, the smoother the transaction and the higher the value. But when you're looking at picking or choosing an advisor, your bench strength, the main thing is to make sure that their values are aligned with your values, your mission, your goals. That's first and foremost. Outside of that, you're really looking for experience. Do they have the right experience in the industry? Do they know the correct buyers? And do they really know how to structure a deal in that particular field? A good advisor will be able to bridge the gap regardless of where you are in the economic life cycle, whether it's headed towards where we are now, or if you're in quote unquote good times. A good advisor will be able to work with you. But not only that, a good advisor has to be open and honest. And sometimes that means being the pointy end of the stick. You have to be able to have open and honest conversations and sometimes tough conversations with not only your client, but also the buyer to keep the process moving along. Deal momentum. The biggest fatigue area for a deal is in due diligence. So you have to be able to to keep pushing the envelope and moving the deal forward.
Have you ever read a book called Built to Sell?
No, I haven't.
I forget who the author was. I'll look it up after. But essentially, it's kind of like a Rich Dad Poor Dad
right
format where it's a fictitious relationship. Like there's this business owner, this lowly business owner, and he's got this super rich and super generous friend, if you will. Sold tons of businesses, gives away all this advice for free. It's complete nonsense, but it's the book essentially is walking you through. These are the things as a business owner getting ready to sell that you should think about. One of the ones I thought that was kind of interesting was I read this book a long time ago. There's probably a lot in there that's worth mentioning, but they were talking about customer concentration. So you've got a customer that represents 80% of your business, let's say. And if I recall, like the feedback, what the book was trying to advocate for was like you need to start saying no to that customer. Easier said than done, right? But the philosophy was that you might see a dip in your cash flow, let's say, initially, but your multiple might actually be more favorable because you don't have this looming concentration risk issue. And then the second part of that argument was, you're going to free up your bandwidth to go and find additional business, maybe more profitable business or whatever. Like, how do you guys, what position do you take when you come up against a business with a lot of customer concentration like that?
So we have in the past quite a few times, and it really depends on the business. Most times, more often than not, on a typical business, customer concentration is not a positive point, but it really depends on who that customer is and what you do for them. Have you positioned your company and your business in a way that it's a two-way street? You can't do your business without them, but they can't do their business without you. So you've made yourself irreplaceable. And in that sense, having that customer concentration at 50 to 80%, it's not positive, but there's a story behind it, and it really comes down to the advisor being able to assess the risks and how that works. If the customer concentration, that 80% is related to an industry where there's only 4 or 5 players, well, that's not a bad thing, right? Especially if you have contracts, master service agreements. So on the surface level, it looks like, okay, that's an issue. And a lot of firms, private equity, strategics, they will just look at that one chart and say, no, right? It's 80%. That's too much. What if they go away? Well, as advisors, let's talk about it. Let's dig into it a little bit further. So really deal by deal basis. Every deal has its own little flavor.
It would be such a, maybe it's not more prominent. It's such a common thing out here in the energy sector, right? Because you have a massive producing customer, and then you have a small, highly fragmented services provider. And I remember one time, this was not an acquisition deal. A business had 50% of its receivables or revenue coming from this single customer, but it was a 25-year relationship.
Right.
There are MASs and stuff like that in services, but I think the customers are able to break them because if you ever want to do business with that customer again, like you're going to renegotiate the terms, right?
Right.
And so the argument was always, look, they've been doing business together for eons.
Right.
And then one day they stopped. And then the business didn't do so well. Like it was hard to plug that gap super quickly.
Sure.
And I think, there was a moat. There was a moat that we thought was there that evidently it wasn't as wide of a moat as we thought. So the business went through some duress for a while there. I kind of moved on before I ever saw the end of that story, but
okay.
It's always in the back of my mind, only because that's usually how, when we were as a lender, like that's usually how we would mitigate customer concentration. We're like, yeah, but they've been doing this together for 40 years.
Right.
But it can stop on a dime. Like it was kind of an extreme lesson.
Right.
But I know, relevant, but
yeah, well, when you bring that into the M&A scope, this is why there's management transition. Now, typically speaking, that relationship has been held together by one individual or a group of management team. So when owners, and this is another big, a main conversation piece that we have with these owners is, like I said, some decide that they're going to wake up one morning and decide to sell, and that it's 6 months away. It doesn't work that way. Unfortunately, I wish it did. A typical transaction by itself takes between 9 to 12 months on average. And in that type of a scenario where there is customer concentration or there's a long time customer that's built off, a lot of time handshakes, no signed agreement, a buyer will mitigate the risk by a management continuity contract, whether that's with the owner or the management team. And that can be anywhere from 6 months up to a year or two. So when you look at it, a transaction, it's not really 6 months at all. It could take up to 2 years for the owner to wake up one morning and say, okay, I want out, to when they are actually fully exited the business. And, the management continuity, like I said, that is a very important factor on how to mitigate customer concentration.
Yeah, you don't get out of your business that easy, do you?
Not that easy.
It requires some patience.
It does. Like I said, most business owners, it is their full-time job. But if you're talking to an advisor early enough, that is one of the key points of how to increase the value of your own company is start grooming, if you haven't already, start grooming a right-hand person or a team that can take over the roles and responsibilities of you post-sale. Like I said, it lowers the risk for the advisor or for the buyer, and it incrementally adds value for the seller and the business, because the business can then technically just run itself.
Is that the most common issue, is key person risk?
Yes. Yeah. Yes. Yeah. In the purchase and sales agreement, there's always a component that could hold up the deal, and it relates to key employees. A buyer will try to classify everybody as key employees, but really there just needs to be, like I said, a right-hand person that can do what you do, or a small group of team, individuals that can take over the roles and responsibilities. But yes, that is the first conversation that we'll have.
When somebody first calls you, is there a pre-screening process? I mean, because I guess there are two reasons I asked that. One, tire kicking is a super common challenge for your industry. But then the second piece is those customers, those sellers, they think they're going to sell 6 months from now. They don't know what is actually involved, and two, they don't actually know if they're sellable yet. Like, is there a feedback process or a scorecard that you kind of work through when that call first happens?
Yeah, absolutely. So it's, like I said, it's a process that's been developed over 30 years, and I'll take you through it a little bit. We first start off we look at the business as a buyer will. So we're looking at it through their lens. We're trying to find, and we're looking for strengths, opportunities, weaknesses. So the critical components of a business that the buyer is going to look at. And we do this through what we call range of values. So that is the first phase in our process, essentially a full valuation, right? So we're looking at it like a buyer will. We go beyond just the financial statements because we are looking for that compelling story, and honestly, is the business worth buying? So those quantitative and qualitative factors, we talked about it, customer concentration, customer loyalty. We look at the strength of the management team, the GM, employee retention, things outside of just the financial statements, and that leads us to the setting expectation phase.
Which is painful, probably.
Which is sometimes it's a tough conversation, but like I said, a good advisor will sometimes have to be that pointy end of the stick. This setting expectation is, we know once we're gone through your business model, in that particular industry, who the buyers are, what kind of transactions have happened, and what the multiples are, most importantly. So when we look at that, on top of the valuation that we've done, we're able to know the factors that are going to have you at the higher end of the range of the valuation or the lower end of the valuation. And if the value is aligned with the business owner, then we go to market. If it's not, then we already know the business model well enough that we can suggest ways and techniques to help get the value to where the business owner needs it to be before they test the market. The last thing that we want to do is take a business to market if we're not aligned, because that's a waste of time for the business owner, and time is money for them.
Yeah.
And I think that's why Maxima is good at what we do, is because we have these conversations and we set expectations up front. Having a high success rate like we do, it's a component of having those tough conversations and realizing that we know the market at this time.
How about we talk about the M&A process? Like, what's it actually look like? I mean, maybe not step by step, but high level.
Yeah. So we talked a little bit about the first phase, which is the range of value phase, the setting expectation phase. We're really trying to find that compelling, and I'll say this a lot, we're trying to find that compelling story, and we only take you to market if there is a compelling story and we're aligned on value. So once that's done, now it's really the fun part where we're in market. So we're trying to find the buyers that are active in that industry at that time, whether it's private equity or strategics, and we build a list of buyers that are approved by our clients. We know that confidentiality is very important. It's our primary goal, and we have NDAs in place that protect the information and the process. So while that buyer list is being made, we're building the compelling story through a corporate profile or a SIM, confidential information memorandum. That's that's a mouthful, but that's essentially the package that's talking about the history of the company, the milestones, the management team, products and services, everything that makes the company what it is, the secret sauce, you can call it. So we're working with that. We're leading the conversations. We know what's important to the seller. And it's important to remember that not every buyer that presents the highest value is the right buyer. They have to be aligned with your goals and how you treat your employees and how you've been doing business, your philosophy. And if the advisor has done a good job, that gets reflected through the LOI. So we will lead the LOI negotiations knowing that we know what's important at the end of the day for our client, to the point that it's accepted. And then the best part, due diligence. Everyone's favorite part of a transaction, dealing with lawyers, accountants, us. So we'll lead that process as well. We have our own internal data room, VDR, and we will manage the interactions between these lawyers and accountants on both the buyer and the seller side.
It's an interesting point, right? Because if you haven't sold a business before, or if you haven't owned a business, you would just naturally assume that there's one priority when you're selling a business, and it's price. But it's a good point, right? Like there's a lot of intangible stuff tied up into it. Like you might have worked with the staff for 25 years or whatever it is. Like you want them to be in a good spot too. You don't want to hang them out to dry. And the buyer, picking the right buyer is kind of critical to making sure that the staff is taken care of, that the legacy, whatever that is, that the legacy is secure as well. So yeah, honestly, I think I probably knew that, but I hadn't really thought about it that closely. So,
well, it's their baby, right?
Yeah, very much.
They started it. They were of
their name might be on the door.
That's right. That's right. Yeah. And a new buyer could come in and just completely take that away, which could be okay. But like you said, employees, they've helped you become what you've become, and most owners value that very high. It's really shown when they're talking about their employees and the management when they're discussing it with the buyers. It's really up to the buyer to either be aligned on that, or they're not the right buyer for you.
Sure. How about broader market observations? I mean, you've had this, I don't know if silver tsunami is the right word, but you've had this anticipated demographic shift, and it's probably been out there for eons. And it felt like, it'll happen this year, it'll happen this year. It feels like it might actually be happening now. The offset is you've got interest rates, recession risk, and inflation being a bit of a buzzkill.
Right.
What do all those things combine to, from your perspective? Is the market busy? Is it stable?
Well, when we look at it in just the M&A world, the fastest and most efficient way to transform a business is through mergers and acquisitions. Like you said, the environment right now, the economical, the financial, the technological is changing every month. You brought up interest rates, inflation, wages, cost of living. You go macro, you've now got geopolitical concerns, trade wars. The market is impatient. It's very impatient. So rapid adoption is the only way that you move forward, and deals are a big part of that. For example, look at COVID. Because of COVID.
What's COVID?
Oh, what's COVID? Let's not talk about COVID. A company had to change, adapt, or die. And it was mainly surrounded around the supply chain. So acquisitions did happen to keep the momentum high or find new ways to build momentum. When you mentioned, like, how does that impact the business owners? They're all feeling it. They felt it for a long time. We haven't been in a thriving environment since, long time ago, like early 2000s. But since 2012, it's been tough for business owners, and COVID was almost the last straw. It was the last straw for a lot of owners, and once we got past it, now we're starting to these buzzkill words of inflation, recession. So how do people adapt? If you look at the deals on a number and value basis between mid 2020 and till mid 2022, it was the trajectory was just insane. It hadn't been seen before. It helps with mergers and acquisitions. They help with economic turnarounds. They help with just building the core strength of a business. Whether it's a lot of business owners, they can't rely on banks anymore to protect their downsides. They have to now find ways to cut their own costs, manage their costs, and strengthen their balance sheet. So their core strength. So either you can go out and add to your core strength or supplementary strengths, or you make yourself a desirable, attractive target. And it's a unique situation now where buyers and sellers in this tough time have to share risks. Whereas before, in good times, so to say, there was a lot of cash on close for deals. Lower amounts of vendor notes, lower amounts of earnouts. Now, a buyer wants to share that risk with the seller. So you shrink the cash on close quite a bit, 10, 20, 30%. VTBs, vendor notes, get expanded, so do earnouts with a lot of clauses on there. So that's not saying it happens for every deal, but it is the trend that we're seeing. Buyers and sellers have to share the risk. And this is where having a good advisor really helps. They need to be able to portray and convey that compelling story, where a buyer shouldn't, and the right buyer won't penalize you for factors that are outside of your control. And the only way to bridge the gap between the two is finding a way to make the deal work with risk sharing, so different type of structures. But also, the advisor needs to know that the buyer needs financing in most situations. That's your world. So we have to be able to make the deal work for both sides, where the buyer can go to a bank and get financing. Covenants, coverage ratios, things that you know way more about than I do.
Simple math.
Sure.
It's VTBs can be a contentious thing, right?
Yes.
I think the seller, it's an expectation management thing. The seller is expecting to be fully out and be able to kind of wash their hands of it. It almost never happens, right? I mean, and it seems like the sooner you can get that feedback out to the seller, the better, maybe even before they're ready to sell.
Right.
And I don't know where the expectation came that it's always cash at close. I can't imagine, was there ever a time when it was entirely
20, 30 years ago?
Was it?
Deals were done on handshakes, and there wasn't a lot of diligence involved. Some business owners are still of that mindset where, a handshake means more than a signature. It could mean that for when you're dealing with certain customers and when there's back and forth. But when it comes to a transaction, you need to have the proper proper bench strength, accountants, lawyers, us.
Yeah, especially I think they'll talk their way into the VTB, and then they're like, okay, well, give me some scheduled repayment. And then the rub is, if you need the VTB to be equity
right
in the deal,
right,
well, then it needs to look like equity.
Right.
And in most cases, equity doesn't have a scheduled principal repayment, right?
That's right.
And that becomes another contentious topic entirely, but I think it seems like vendors just need to recognize that in a lot of cases, that VTB doesn't get paid from the buyer or the business. It gets refinanced, right? So, the debt gets paid down. the senior debt gets paid down over 3 years or whatever it is, and at that time they'll go to the bank and they'll leverage it up, and then cash goes to pay out the VTB.
Right.
That works a lot, and I think the vendor just needs to come to grips with that, right? Like they're worried about never getting paid out on it,
right? Because you're never first in line.
Yeah,
the bank is always first in line. An easy way that we talk about the VTB is it's a way for tax planning. Cash on close
to defer capital gains.
That's right. Cash on close is immediate tax, and yeah, you're right. You can defer those taxes over the VTB note, whether it's 2 years, 3 years. Typically, you don't want it more than that. But there's interest payments, so it's not an IOU for free.
Yeah.
As long as there's some type of repayment, whether it's quarterly, yearly, it is a good way for a tax strategy.
Yeah, fair enough.
Yeah.
How about your background and expertise? As far as I understand it, you're an accountant.
I'm an accountant by trade, but
no offense to the accountants. I'm just joking.
But I'm an accountant by trade, but I love doing deals. It's exciting. The process and just the ways that there's always more than one answer to a problem or a situation. And I've been involved in a few deals now, starting with my first one was the Parkland Chevron acquisition, and then transitioning into the mid-market M&A team at RBC. I've been lucky and fortunate enough to be surrounded by entrepreneurs. I've been ingrained in that industry over the last 8-9 years. Honestly, that's the best part of doing what I do. Is being around these accomplished entrepreneurs. They every single one of them has a unique way of thinking, and if you talk to enough of them, it really does elevate your perspective on how to run a business properly. That's it's something that they've built. They're proud of it. Like I said, they call it their baby. It's provided a good life for themselves, their families, the employees' families. So when we see, the look in their eyes and the relief when there's a successful transaction, it's incredible.
You are who you spend time with, right? Like if you don't spend time with entrepreneurs, the odds of you being able to endure the entrepreneurial journey is super stinking tough.
Yeah. And as advisors, you're not just advisors. You're also a part-time therapist, part-time, there's a lot of hand-holding involved, which is good, because for most of these guys, they're going through this transaction for the first time, and they're really relying on you and looking to you for help and really managing their emotions. It's not an easy decision. It's like I said, it's a roller coaster of emotions. The ups and downs of the transaction. They once the LOI is signed, a lot of owners are thinking, okay, that's it. But that's where the fun begins.
Yeah, fair enough. Okay, we're at 40 minutes.
Oh wow.
I'll skip some of my questions, but
sorry, I like to talk.
That's no. I think it was me more than anything. Final advice for the audience. Those contemplating buying or selling a business, let's say.
Okay, I'd say the biggest piece of advice that I can give is to leave yourself enough time for an advisor to come in and help, and be surrounded by a strong team. Whether that's you're looking at the management side, like your own operations, and externally through the advisor. So when you're looking at the management side, start grooming and make sure that there's a right-hand person or a team in place. It lowers the risk for the buyer, which is going to increase the value for yourself. And it's going to make your life easier if they're able to take over the day-to-day already. As far as the advisor, like I said, the main thing for the strong team there is to make sure that your vision is aligned with their vision, and find someone, an advisor that's just not a yes sir, yes ma'am, someone that can push back, someone that can set expectations. It's funny, I always say that if at the end of a deal, of a transaction, if whoever's on the other side comes back to the previous owner and says that your advisor was a tough negotiator, then we've done our job. So, surrounding yourself with a team, the right buyer will value what you value. So do that. Oh, one more. Get a hobby. It's incredible.
For afterwards, you mean?
We'll start now.
Oh, okay.
The number of buyers, after successful transactions, they come back after 6 months saying, I'm bored. Help me buy a business. Yeah. Right? Their hobby was the business. They were invested in it, growing it. So get a hobby now.
It's a common issue in banks too. I mean, folks retire and they're like, well, now what the hell do I do? And hopefully you get along with your spouse.
Yeah. Setting sail into the sunset is easier said than done. Like I said, these entrepreneurs, their brain is always going. They want to know what's next and how to expand what they're doing already. So I think getting a hobby will help with that. You don't need to be running another business at 55, 65.
Yeah. Get a hobby.
Get a hobby.
Where can people find you online?
They can Google us, the Maxima Group, www.maxdg.com. We're also on LinkedIn. We constantly send out market updates, process updates, deal updates, what we have on our desk right now, what's upcoming. So if you're looking to buy, you can look there. Or if you want to start having a conversation about selling your business, like I said, the earlier the better. You can give us a call at any time. We're lovely people to talk to. We've got a great team, and I'm pretty okay to talk to after my first cup of coffee.
Yeah, aren't we all?
Yeah.
Right on. Okay, well, Abby's ready and waiting by the phone, and thanks for joining us, man.
Thank you, Kyle. This was great. I appreciate you having me here.
Cool.